let's look at the all-important US 10-year yield. It's a huge deal, and yeah, let's first, read the disclaimer carefully, and then do your good deed of the day by liking and subscribing. So, we go here to indexes, and here we have it. So, this is the interest rate for the 10-year Treasury notes. So we have seen a pretty substantial 224% move here from the low, but we are minus 7% here away from the 52-week highs. So this is the weekly data points, and this is the giga picture for the 10-year yield. Very clearly, it's been in a very substantial downtrend. That's been, the primary move, quite obviously. We do see that there's been some time cycles throughout that have been relatively reliable, not perfect, but especially recently, they have become rather surgical. So you see here, low, rise, decline. And this is going way back. Here we are talking about 2008. The previous big bear market. Hence it is very relevant. So rise, decline, rise, decline. Given that we are currently part of the rising phase here of the 10-year yield. In the previous phase, it peaked here towards, actually later into, it actually peaked when you would expect the declining phase to begin. The decline did definitively come though. Here you saw a peak a bit early. In this instance, we peaked a bit early, but then we had that final push before the decline. So basically, due to the history, there's reason to expect that there could be more left in this move. What I do find interesting, that is this pattern, which you could argue we have an inverse head and shoulders pattern developing. That's very interesting because inverse head and shoulders pattern, they go up. Well, they have a tendency to go up. So if we measure this, the left shoulder took 196 days to develop. The right shoulder, if we take 96 here, so that pushes us into the 27th of September of this year. That is, of course, if it is a very symmetrical development. When we compare the time cycle with the seasonality here of the 10-year, then we do see something rather interesting. So April, May tend to be weak, but June is one of the strongest months here for the 10-year yield. The current month. July, August are the weakest. Then we have strength in September. Well, generally stronger in September, and then very much strength here in October. Hence, you do see that fit here between the seasonality and the formation here of a right shoulder. Hence, there's a very real possibility, that in the strength of October, that is when you are going to see that right shoulder fully developed, and we do get that breakout to the upside. That would be a big deal. So, yeah. Let's look at some correlations. By the way, this recent pullback here in the 10-year, it came after we had an excessive RSI, historically very excessive, and we also met here horizontal resistance. So it wasn't like a huge shock when it came. Here are the daily data points, and you can see that there is this relatively nice formation here of this inverse head and shoulders pattern, and the breakout to the upside, that would be a very big deal, because the bond yield, the bond market in general is a huge big deal. It is way bigger than the stock market, and the entire post-war capitalistic system has been completely dependent on debt. It's all about debt, and any substantial move in the debt market is going to ripple through all the other markets. So let's look here at correlations. So here we have the 10-year yield in the background. And let's look at the statistical correlation over long and shorter time frame across different markets. So here you can see, so this is the S&P 500. So you do have a minus 47% correlation with S&P long term, but you can see here that the statistical correlation, it has certainly changed over time. Like here you have, like here as an example, in the late part of 2018, you do have a strong correlation between the 10-year yield and the S&P. So here you had 87% positive, and if you look down here, that was the late part of 2020. Then all of a sudden we have a minus 65% correlation. But anyway, you do see that there's this overall general range it stays within. So 46% negative, but then we look at gold, then there's a minus 91% negative correlation currently, which means that they more or less move opposite each other. If you look here at the dollar index fund, then there's virtually no correlation. So it's like minus 6 at the moment. And then you have minus 53% with the Cathy Wood ARK-K innovation fund. So here we go to the daily data points. And in this instance, you see that there is an 84% positive correlation with S&P 500, which means that they tend to move up together. Here, the negative correlation with gold, it goes down to minus 59%. There's a positive 35% correlation with the US dollar index, and the minus 42-ish with the ARK Innovation Fund. Now let's do another round of correlation studies. So this, I know that for some of you this can be a bit dry, but this is actually one of the most important things to look at, when investing. You absolutely need to know what is the statistical correlations between something, very important and other types of investments. And definitively, the 10-year yield it's a huge deal. So the big shot investors, and one of the first things they look at in the morning is what is happening to the 10-year yield. So now we are looking at the weekly data points, long-term correlation here with first, crude oil. So here, there's a 75% positive correlation. So not perfect, but they do, have a strong tendency to move together. And that, has held up, for quite some time here. You see that here at, the low point, we had, 36% correlation, but you see that it has generally stayed positive here ever since 2013. When we go here to the QQQ, and that's the Nasdaq, and that's something, a lot of people made a big deal about, the correlation here with the 10-year yield. And you see here that there is, a rather solid minus 64% negative correlation here with the 10-year and the Nasdaq, which means that they do have a tendency to move against each other, which means, based on the current correlation, if we were to see that inverse head and shoulders pattern confirmed and a sharp rise then in the 10-year, that would be bad news for the Nasdaq. So here is the IEF. That's the 7 to 10-year bond ETF. And here there's a perfect negative correlation. And that is basically how, because the yield and the bond ETF, they move opposite each other. So yeah, you have that correlation, but I just wanted to have it here such that you are aware of that link. Because many people find this whole thing about yield and the bond price confusing. But here you can see, the very clear negative relationship. Then here you have the financials. So XLF, this is the financial sector spider ETF, which only has a 16% positive, much less than what you would expect by, what the talking heads are saying.